And you know what? $3,000 isn't a number that excites me at all. I wouldn't own as much gold as I own if I thought it was going to go from 2,700 to $3,000. I own it because several times in my life it's gone up fivefold or sixfold or sevenfold. I own it because the net on balance sheet and off balance sheet obligations of the U.S. government exceed $120 trillion. And those obligations, both on and off balance sheet, annually exceed the gross income of the federal government before expenditure. That's why I own gold. I don't own it because I hope it's going to go to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000.
In a world where the US government's on and off balance sheet obligations now exceed a staggering $120 trillion, Rick Rule warns this isn't just a debt crisis, it's a ticking time bomb for the economy. Yet amidst the chaos lies what he calls the opportunity of a lifetime. Gold, an asset he says has surged 5 to 7 times in value during past economic upheavals, is his ultimate hedge. If you're worried about the dollar's decline, Rule argues this is the moment to act. Not because gold might climb to $3,000, but because it could skyrocket to $9,000 or more.
Gold itself for savers, I regard gold as insurance. We probably don't have enough time in this interview to go over that. But I think that anybody who doesn't own physical gold, well, I won't insult them. I just believe that everybody should own physical gold. The dichotomy between, like oil and gas, the enterprise value of the best gold producers and the gold price is at historic lows. And if the gold price continues to do what I think it will do, which is to say go up, the gold producers will enjoy a catch-up. So investors need to be in the space. The biggest moves, of course, will be in the alpha part, the speculation. That's not suitable for everybody. That's only suitable for people who can stomach volatility, accept real risk, and do a lot of work. But I think that gold as a sector is unique in that it warrants a lot of attention for savers, for investors, and for speculators, which are three different classes of human being.
Mm-hmm.
I really think it's a simple thesis, and it's a thesis that when it plays out, generates spectacular benefits. You know, Adam, I'm not one of those who suggests that you buy gold because it might go from $2,700 to $3,000. I'm one who suggests that you buy gold because I remember the decade of the 70s or the decade 2000 to 2010. In the first instance, the gold price went up 30-fold. In the second instance, the price of gold only went up 7-fold, which is to say, I don't buy it because I think I might enjoy a 15% move. I buy it because I'm afraid of a 3 or 4-fold move, literally afraid of a 3 or 4-fold move. In the investment side of the business, I buy it because it is historically, by it now I mean investment quality gold stocks, they are historically cheap. And if I'm right about the gold price, I'm really, really, really right about the senior producers. I think relative to the gold price, on an enterprise value to net asset value basis, which is the right way to view it, or on a price earnings or price EBIT basis, that the gold stocks relative to current gold prices are the cheapest I've ever seen. And the high quality speculative stocks, by the way, most speculative stocks are not high quality. I'm talking about 10% of the speculative stocks. They're even cheaper. That isn't an arena to go into if you can't take volatility risk and do work. But I think it's one to consider at any rate. I need to preface that, Adam. We've tried to do it earlier, but I need to preface it by saying that I don't believe the inflation statistics that we're fed.
Right.
Anybody who's listening to this, all they need to do is think about the increase in rent, in home mortgages, in car pricing, in health insurance, in gasoline, in groceries, in the period 2020 to 2024. And the idea that the purchasing power of your currency is declining at 2.5% a year is ludicrous. And if you look at the on and off balance sheet liabilities of the US government and their ability to do anything about that other than inflate away the net present value of their obligations, I think the chance of that is nil. If you look at those two circumstances and you still own long-term US Treasuries in favor of gold, it's because you flunked arithmetic in school.
It seems that when investors get bitten by the gold bug, they often go whole hog. In my life, when gold has moved, the moves have been dramatic. And if you think of it as I do, as insurance, a fairly small premium goes a long way. If, as an example, you had had gold at the beginning of the decade of the 70s, understanding the type of inflation that we would experience in the 1970s, when the gold price moved 30-fold, had you had 10% of your portfolio in gold, you would have enjoyed a triple over that decade on your total portfolio. If you had gone through a much more modest bull market, like the period 2000 to 2010, where the gold price went from $250 an ounce to $1,750 or $1,800, which is to say a sevenfold increase, a fairly small proportion of your net worth in gold would shield most of the rest of your portfolio from the harmful impacts of the deterioration in the purchasing power of the U.S. dollar. Many, many, many people overinsure. Many, many, many people have too much of their assets in physical precious metals or more riskily in penny stocks associated with gold and silver. I have now, as you know, Donegan, graded over 100,000 portfolios in 10 years of grading portfolios. And while I realize that $100,000 is a fairly small set of the investing public, I do note that when those people, some of those people, get bitten by the gold bug, and I suspect a high proportion of them are your listeners, that they tend to go overboard. But I'd like to discuss it. The gold and silver price is nominally, at least, as is suggested, set by the LBMA and the COMEX. It's important to note that most days, the futures market in precious metals trades over 100 times the amount of gold and silver available for physical delivery. To the extent that increasing amounts of physical gold in particular are removed from access to COMEX, you set up a circumstance where perhaps ultimately the tail stops wagging the dog. I'm not saying for sure that's going to occur, but I think it's a very interesting circumstance. And it's interesting to note, too, that when that happens, many people who suggest the inevitability of, pardon me, the inability of that to become a problem forget the fact that in order to settle COMEX or LBMA obligations, the physical gold and silver has to be good delivery, which is to say all the scrap gold and silver, all the gold and silver outside the system, all the gold and silver held by the Indian peasantry, can't automatically be used to fulfill those obligations. It needs to be often re-refined, re-assayed, and entered into good delivery. So the circumstance where the continued warehousing of gold by foreign central banks begins to disrupt the availability for good delivery in a market where 100 times the amount held for good delivery trades every day becomes an increasing challenge. I would tell people, too, that one of the reasons why you should hold your physical gold and silver in system available for good delivery is that very often if you're engaged in midnight gardening, which is to say if you hold the gold and silver yourself in your backyard and you want to take advantage of price movements, short-term price movements, you need to reintroduce that gold or silver into the system. I'm not suggesting that there aren't other reasons to have physical gold and silver in your possession as opposed to in system. But if you are using it as investment liquidity, it's important that you have some in system where it actually is liquidity. I think that the framers of the Constitution, on balance, did a good job, particularly with regards to the Bill of Rights. You will notice that politics triumphed then, too. Those rights were not extended to indigenous Americans. They were not extended to African Americans. They were not even extended to women. Some people would argue that that's wise. I'm not one of them. I think, I'm guessing, I wasn't there, despite the appearance that I was. I suspect that the framers of the Constitution, particularly the people who inserted the Bill of Rights, would have preferred that the rights that they enumerated were universal. But that's not the way politics works. And you know what? $3,000 isn't a number that excites me at all. I wouldn't own as much gold as I own if I thought it was going to go from $2,700 to $3,000. I own it because several times in my life, it's gone up fivefold or sixfold or sevenfold. I own it because the net on-balance sheet and off-balance sheet obligations of the U.S. government exceed $120 trillion. And those obligations, both on and off-balance sheet, annually exceed the gross income of the federal government before expenditure. That's why I own gold. I don't own it because I hope it's going to go to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000.